All right, welcome to day two of Topstep Trading Strategies. We're going to be talking about some of my favorite chart analysis, some chart patterns, also discussing some of the other things in charts like oscillators, and another discussion of volume and open interest, and some look at order flow and some gap analysis. So we're very excited to have you with us today. And looking forward to a good session. One difference, we had added a question and answer section. If you have specific questions, you can go ahead and put them either in the chat, I guess, but we can also put them in the Q&A section. We have Jack Pelzer and John Doherty here with us. Good morning, or good afternoon, gentlemen, I should say.
Yeah, good. Just afternoon, Hoag. Yeah, I mean, if you have a question, please put it in the Q&A because then it gets stickied versus it might get buried in the chat. So we'd prefer it there, and we'll get to them at the end during the Q&A.
Thank you, Jack. So this is again a very wide area of study. It would be days of this before we would be able to get through all the chart analysis and all of the things that we as traders have available to us to use. You certainly shouldn't be using everything in order to make your trading decisions. You got to find what works and what speaks to you. And this is just a few of my favorites and our favorites. And we're hoping that this is going to help. If you don't know me, my name is John Hoagland, the senior performance coach here at Topstep. I've got more than 38 years of industry experience, 30 years actively trading, having traded on the floor of the Mercantile Exchange for 20 years and migrating to screen trading in 2009, and currently still trading. And I've had the pleasure of being part of Topstep since about 2011, and I've had the benefit of the ability to talk to and hopefully help thousands of traders from all over the world. And I'm looking forward to helping in any way I can here. It is good to see everybody. I'd like to comment, Dan, Julius, David, good to see Dan Emmons here. Good to see you. Scott saw and he conquered. Jim, good to see you. Burrell, JD is with us, of course. Dan, Daniel, Andre, David, Jim, Tudo, George, good to see you. Daniel, Bill Phillips, Ben, a lot of familiar names here and a lot of new names. Steve's talking about taking the plunge and signing up this week. Had a very profitable year, but habits are bad habits and some are tough to break. That is for sure. Theo, good to see you. Dimitar, Mario, and Daniel. Wow, it sounds like a lot of Dans. I know it does sound like there's a lot of Dans here, doesn't it? Dans and Davids. All right. Chart patterns. Some of the common chart patterns and some of the ones that I look for most readily are triangles, flags, and head and shoulders. This is a typical flag formation. Flags are formed as a kind of a rest period in a larger move to the upside. If this were a daily chart, we can see that the market has moved up to this level. A flag is formed when the market starts to form smaller ranges opposite the bigger picture. Okay, so when we have a market that's directional and even in any time frame, really, if this were a 5-minute chart or a daily chart, I would look for this flag to form, allow a little bit of rest in the marketplace for the market to kind of even up inventories in any time frame. And then on a breakout above the top trend line, that would confirm the bull flag, and we would be able to perhaps expect a larger move to the upside. Now there's a way to measure moves using flags by looking at the flag pull, how far the market comes up to the flag, and then taking that measurement and taking it from the breakout point and extending that measurement in space or to the upside or to the downside for an expectation of possible profit target when it comes to flags. It's one of the things that I like about them the most. If this were a daily chart, when we begin to form the flag, you're going to have small ranges, and you're going to see volume slow. You're going to see hopefully volume continuing to increase on the way up. The formation of the flag would cut volume off. And then on the breakout above the flag, you would be looking to see a pretty substantial increase in volume, substantiating the fact that the flag has existed and now has broken to the upside. And after this move, after you get the breakout to the upside above the top channel of the flag, you're certainly going to be looking for opportunities to buy weakness. You get some substantial, you get some acceptance above the flag, you're going to try and buy pullbacks and look for the continuation to the potential profit target, which is based off in essence, the flagpole extended above there. We look for the opportunity. If you watch the forecast or the recap, quite often, I'm pointing out these flags usually on a daily chart. And does it mean that it has to reach a specific profit target? It does not. It does not. It is something that we use as a general reference for continuation and a potential profit target, but there's nothing in futures trading that has to happen or doesn't have to happen. Okay, so if this were our flagpole, once we broke out, we would take this measurement extended above there for a potential profit target for a breakout above a flag. It is, again, one of my favorite patterns on the daily chart because it allows us a couple of things. When we find that we're in a flag, we can work both sides of the flag, selling short above this line, getting long above this line in a range type strategy. And then once we get the substantial or whatever you would use to verify a breakout of this, then we go with the breakout. It's very similar to a situation where we're range bound for a period of time, you're fading extremes, and we go with the breakout from the area of balance. One of my favorites is the flag formation, and I do look for them, and we do discuss them in the forecast and the recap when we do see them forming. Sometimes they provide wonderful, great opportunities for the day time frame trader that's in the right seat at the right time. They're not always all that tremendous, just like anything can and will happen. When we see a double bottom or a triple bottom or a triple top, this would be a double bottom. The market has to come down to this level and place a low, a swing low, we would call this. You get the market coming off that swing low. Upon a return to that level, it gives us the opportunity to potentially see a double bottom or a triple bottom form. But there is, of course, no guarantee of that. Some say that the double bottom has to stop short of the previous swing low. Some say that the price has to go slightly through the bottom of through the previous swing low. All of them can and at times will be right and some will be wrong. The thing I like about the double bottom or the triple bottom is it offers the opportunity to limit risk. Limiting risk is number one. I don't take a trade until I've established where price has to advertise to prove me wrong. And a double bottom does allow that opportunity. And it does make a difference as to whether this double bottom is on a daily chart or a 30-minute chart or a 5-minute chart as to the magnitude of risk that I have to take. But if you know me, I don't like to take big risks. So I look for these patterns to give me the opportunity to limit risk first. If I'm going to be taking a trade here, I'm thinking, okay, well, if we get down two down below this level here, the price is advertising at a level that kind of proves me wrong, and I have to get out of it. So where can I get in as cheap as possible to get into this trade and lose as little as I can on a continuation down below that level. What I'm looking for on a double bottom is for the market to give me, oops, sorry about that, for the market to give me evidence that the auction to the downside is tiring. I'm going to want to see volume begin to slow. I want to see open interest begin to slow or go the opposite direction as we get to this level. When we bounce off of that and we come back to that level, I want to see the same thing happening. I want to see volume slowing. I want to see volume slowing. I want to see open interest dropping off as we get close to this level, because what this is telling us is this area right here was too short to continue to push to the downside. The auction process was good on the way down. It's showing evidence of tiring at the lows. We put in the low, we bounce, we come back and retest that low. I'm looking for the same thing to happen. The market is viewed as too cheap at this level. Coming back to it, the market may also be advertising as too cheap that back down at that level, and then we get our opportunity to look for the long and to continue to look for longs as long as the upside continuation continues to present itself as healthy. What is a healthy auction? We're going to be talking about that again here today. Triangles and pennants. Also, one of my favorite opportunities, because we have two opportunities to profit during these type situations. When we have a low here, we have a high here. The market puts in another low, puts in another high. That puts in our trend lines. Okay, now, as we all know, a trend line that is revisited more often is more substantial than a trend line that is not revisited very often. We're putting in lower highs. We're putting in relatively even lows here. That kind of gives us the pennant formation. It's whether it's an a downside trend pennant, downside pennant tends to break out to the downside. And a pennant in the opposite direction with a flat top and the higher lows tends to break out in the opposite direction, in the upside direction. These are just basic rules. Nothing has to happen, and anything usually will. Just as a higher probability, when we do have a pennant formation, the pennant tends to break out towards the flat side. In this case, this is true. We can see how many touch points the upper trend line had here. It had 1, 2, 3, 4. This is a more substantial trend line than the trend line at the bottom here. We had 1, 2, 3, came back down through, closed right at it, and then we get our breakout to the downside outside of this pennant. Another thing that I do like about these is if we take the measurement from where the pennant began, this low to this high, if we take that measurement and start it on the breakout point, which would be here, that can give us a relatively solid profit target with which to perhaps expect an exit for a short once this formation breaks to the downside. Again, nothing has to happen. It gives us a visual where there is a relatively good probability that price will visit upon breaking out of this triangle or pennant formation. Trend lines. Trend lines are funny. Because you can kind of start a trend line just about anywhere. And I found at least in my experience that I have a hard time trusting my own trend lines. Who am I? I am just a guy. that's trying to figure out where this market is trying to go. It could give you really good visuals, of course, helping you decipher what kind of market state that you're in. Yeah, Dan says he agrees. He only uses horizontal lines now, and it's difficult to begin to learn to trust yourself in trading because we never know the outcome. There's no real way for us to be 100% positive or sure in anything in trading, because what we're doing is we're looking at the market, and we are taking a look at what's happened in the past and our current knowledge and experience now, and we're trying to base our decisions off of hypotheses, and we have to be well aware that they may be wrong, and we want to trade as close to points of invalidation as we can to limit that risk. You know, on this trend line, this is obviously the S&Ps. Obviously it's after COVID, because I always have these lines here. Now, this is not an absolute, this is actually not all that correct, but we can see that this low here, I mean, we were putting in higher lows, we're putting in higher highs. That's the basis of a trend. And as long as we continue to hold these lows, we can use this trend line to look for opportunities to buy the market upon weaknesses. I mean, every time after this line here, after this move back down to this level here, every time the market's approached that line, until of course, you know, recently for this beginning of this year, we've got a new trend line to the downside that's begun, but we can use this to limit risk and find ways into the market when the market appears to be at its weakest. Okay. When the market comes to this line, this is telling us that, okay, the market is at risk of changing market state. Anytime you're approaching a trend line, you have that risk, but it also offers you the opportunity to limit the risk that you're going to have to take to get into that trend. Historically, be honest with you, I've been really bad at joining trends that are already in play. But if I'm going to be looking for opportunities to put together a solid trend line with the more touch points, the better, in order to find an opportunity. And I'm going to be trying to buy that market on weakness. Dad always said the market always looks the best at the top and worst at the bottom. So coming to this trend line, it might be tough to take a long against it, but it's the right thing to do, if only for the fact that you can limit risk. Trend lines are tricky. You can put a million trend lines on your chart, and one of them is likely to be a successful trend line. I try not to do it too often. I try and make sure that before I set the trend line, I get 3 touch points, 3 points of contact, because that tells me that that's a trend line that I may be able to trust. I can put a trend line anywhere, but am I going to be able to use it to limit risk? All right. We've got some more information about gaps as we move through this. Let me take a look here.
Oh, there's also a good timely question here that I think before we jump
Sure.
into the next section as well.
Awesome.
Yeah, so Benjamin asked, would you explore and discuss why the patterns tend to work? In other words, what is going on in the market dynamics between buyers and sellers that result in either a reversal or continuation, which manifests as these patterns? So sort of, I guess the question is sort of psychologically, why is it that these tend to be patterns that people look for?
Well, we're all human beings, And when we look at these markets, we're looking at the collective ideas and thoughts of the human beings that are currently trading them. Um, you know, let's say, for example, the flag formation. We've got a whole bunch of traders that are pushing the market higher over time. Open interest is building, volume is building. We're going to get to a point where we kind of run out of buyers with which to continue price action to the upside. Now, we know that there's buyers that are occurring in infinite time frames. Why did they choose this level to stop? We don't know. But the overall opinion of the market by all participants is that the market is still good to the upside, but there's not enough oomph, if you will. There's not enough buyers left to continue a linear line like this. So the market has to come, it has to consolidate, if you will. And I would call a flag a consolidation. The market pushes higher, it runs out of buyers to continue the linear move to the upside, but the overall opinion of the market isn't of the school of thought that the upside move is over. So you get a whole bunch of buyers that are just holding pat here. And you may see some of them lighten up because the market hasn't continued to move. When we get into a flag formation, I think it's a collective flattening of the current move. When we consolidate like this, we even out inventories in enough time frames to where once the market breaks out, everybody says, oh, okay, it's going again. Now it's safe to buy it. And there's enough traders, speculators, whatever time frame there is, have evened up inventory enough to bring the market to continue to the upside. Why are these repeatable? Is because people are generally the same. Markets change people and people change markets. But one thing that always seems to remain true, even going from screen to even going from pit to screen, is these patterns continue to provide opportunity in the right situation and in the right context. The double bottom, obviously, this is a visual that the market came back and retested. It was too cheap before. Maybe it's too cheap now. It's a really deep and excellent question. We could probably do a whole webinar on that. Trying to think of where is the question? I want to see it again and read it. Yeah.
Playing the Jeopardy music here.
I know. Sorry about that. Who was that? Was that Chris?
The original question was from Benjamin.
I don't see it. Did we take it off though? Oh, answered. Okay. Okay, Ben. As you know, I don't like to use the word works. Something this pattern works, or this tool works. It's all in our ability to correctly hypothesize the current situation in and around the pattern. As far as why a particular pattern seems to work and why these all kind of manifest in these patterns. I mean, it's been a study for 100 years, as to why these patterns seem to form over and over again. You've got books from the 20s about these technical patterns, and it just seems to be a truth that these patterns form in trading. As far as making them work, it's so much more up to us.
Yeah, Hoag, to add, like when we in the fourth session when we were talking trade management, so much of it has to do. And I apologize, there might be a little crying in the background here. It's not me. It's the total psychology of crowds, right? Especially when you think about the double bottoms or something like that, or if you're breaking through a new level. Every market participant, a lot of these things simply work because they work, so to speak. When every algo, every market participant is looking at what the high is, the previous high or something like that, it becomes an important level. And then from there, this kind of goes to answering, I think it was Dan's question about grading setups really quick. It's all about trade management at that point. Of course, it's not guaranteed to work. It could be a coin flip. But if you're going to take it for 2 to 1 or 3 to 1, whatever your stop is in that situation, then you can still come out on top.
Thank you, Jack. Yeah, it's the collective perception of value is what I think continues to create these opportunities in repeatable patterns. We're all looking at the same thing, even though we're all individuals and we all have our own motivations and decision-making processes and ways that we view these things. To a degree, we're all humans and we all see things alike. It's a really good question. Really good question. So talking about gaps, when we talk about gaps in the forecast, the recap, anybody that's really talking about gaps, because it's a 23-5 opportunity to take trades. Yeah, Dan, you're right. It's FOMO en masse, right? We all tend to be jumping at the same things, and we know 90% of us are going to lose. So it's that 90% of us that create these patterns. Back to gaps. Gaps are regular trading hour session to regular trading hour session. So we have this session here that creates this volume profile. This is the overnight trade. And then the market opens outside the previous session. When it comes to trading gaps, there's a general rule that we say, if we can't close the gap relatively early, which is again a subjective term, sorry about that, then we go with the direction of the gap. In this case, the gap is to the upside. There's almost no effort to close the gap, and the market continues its push to the upside. Again, does this always, in air quotes, work? No, nothing does. Nothing works every time, and there's nothing that never works. Just knowing that you're opening with a gap, the market is trading outside of the previous day's range, and it's opening in a relative time frame out of balance. The opening outside of the previous day's range and the creation of the regular trading hour gap offers us earlier opportunities to try and get into trades. Opening with the gap quite often will create the best trade location very early in the session. Opening in range, I have a tendency more to just be patient, let the market establish a range early and then work the extremes of that. We don't get that opportunity when we open with a gap. In this particular case, it looks like the opening range was left at the low of the regular trading hour session. Therefore, the best trade location of the day was right on the open, and we could have expected something like that because of the creation of the regular trading hour gap. If we get in, if we open and we close the gap relatively early, it changes the hypothesis and changes the strategy with which I'm going to use. Okay, Support and resistance. Now we've got a bit of a trend line on this, but if we were to draw a line across the top here, and we have a horizontal line across the bottom here, you could say that this market is certainly range bound, and it is, even with the trend line that we've got, that is kind of a pennant formation. Support and resistance are any level that is viewed by the by the community of traders as this is too cheap, this is too expensive. Support and resistance levels can be trend lines, they can be value area highs and lows, they can be points of control that have not yet been revisited, they can be pivot lines, support resistance lines, Fibonacci lines, swing highs, swing lows. Just about any visual that you can think of can become a support or resistance level. When we do see a market that is basically bouncing back and forth between two relatively solid lines, that gives us the opportunity again to limit risk. If we see this and we short above the high, if we short at the upper line, we'll get long at the lower line. We get short at the upper line. We get long at the lower line. We get short at the upper line until there's a relatively substantial breakout away from the areas of support and resistance. This is just a range bound situation. And when we're trading range bound, that's the strategy I use. I fade the extremes. I sell near the high, I buy near the low, ad nauseum until proven wrong. Once we break out of the area of balance, then it's a situation similar to a gap, because once we break out and accept outside of an area of balance, whether it's a triangle, a pennant formation, a box that's providing support and resistance levels, once we break out above it or below it and we bring in volume, we go with it. So you can get wonderful opportunities inside range bound formations, and you can also get a really good notification when that is now no longer going to remain, and we're going to see the market move away from these areas of support and resistance. And again, you can find support resistance lines just about anywhere. You can create them. You can see them in fibs. You can see them in profile. You can see them with pivot lines, support resistance lines. There's a million ways to skin a cat. The point being is recognizing the current market state and trading to that market state. In this state, I'm thinking, okay, well, we failed above here. We failed below here. I'm going to be looking for opportunities to buy the low. I'm going to be looking for opportunities to sell near the high of this line. And again, I'm going to do so ad nauseum until something proves me wrong. The breakout here proves me wrong. These patterns are repeatable. They are again, why they're repeated. Again, it's the collective perception. Who is going to be the first one to step out and hit all the stops outside of this? Who is going to be early in this breakout to the upside? Who's already been burned at buying the high and selling the low? Who's burned here buying the high? Who's burned down here selling the low? You get this whole mass of humanity that have had some successes and some losses. Once the market breaks out, who's going to be the one that's going to really push this thing forward? Is it going to be the longer time frame? Is it going to be the shorter time frame pushing the longer time frame into action? It's anybody's guess, but when we see the market bringing in volume outside of this is no longer going to be valid. We get a pullback towards the high of our area of balance. We're going to be looking for opportunities to buy that. The old Head and Shoulders. The market has to come up to this level. It puts in a high, consolidates, puts in a new high, falls back, consolidates inside the old high, and then breaks out to the downside. One of the old favorites that you can see this on a head and shoulders this way. You can see it in an inverse head and shoulders where you get the shoulder, the head, and the shoulder. The thing I like about it is once you break out, you've got a measured move that happens to, I think, come to fruition more often than most patterns. You've got the neckline here. Okay, if I were to measure from the neckline to the top of the head, okay, I keep that measurement. Once we break out below the neckline, the profit target is that distance from the neckline to the top of the head to the break of the neckline down. Whether it just gives me confidence in the ability of the market to perform that for me, or I've seen it enough times to believe that it's actually going to happen, it's one of my favorites, and we don't really see it all that much. And there's been periods of time when I've actually kind of missed it, and I've had others say, "Hey, isn't that a head and shoulders?" I'm like, "Yep, that's a head and shoulders, all right." Yeah. Use your head and shoulders or have dandruff. Too many dad jokes, Daniel. I was thinking the same thing, but this pattern is a reversal pattern. So if the market comes down to it and then creates a head and shoulders, it's not really valid. You need price to come up to it. Then you get your reversal pattern. Then you get your breakout and your continuation to the downside. Okay, here's that flag pattern. It is, I just wanted to kind of look at this particular slide. It's, you're moving up. You set up trend lines. This is the upper channel line. This is the lower channel line. Where upon breakout, you take the length of the flagpole and extend it above the upper channel line for a potential profit target in it. This is a bigger move to the upside. These are narrow, low volume days. And then you get the breakout to the upside. Oscillators. I've had a love-hate thing with oscillators for a long time. It's a tool that constructs high and low bands between two extreme values and then builds a trend indicator that fluctuates within these bounds. Traders use the trend indicator to discover short-term overbought or oversold conditions, and that's right out of Investopedia. The stochastic oscillator, boy, that was hard to say, is a momentum indicator used to generate overbought and over using 100 to 0 to 100 bounded range of values. So this is the stochastic oscillator. Boy, I'm having trouble speaking. The indicator, when it gets down near zero, there's an assumption that we've gotten too short and that sellers will probably back off. And in a lot of cases, it does kind of indicate that. It's a lagging indicator, however. And so I've had my wrestling with the stochastic oscillator and the RSI. You get this big push to the upside, and still we're not even at 100. What I do like about looking at an oscillator or an RSI is when we get a divergence. A divergence is, you could almost say that the divergence is what we're seeing on the other end of this. So we've got a high here, and we've got the high in the stochastic right here. A couple days later, we put in a higher high, and our stochastic puts in a lower high. this is an indicator that it's a real indicator that the market is exhausted to the upside, because it's still putting in higher highs, but the stochastic is putting in a lower high. When we see these divergences like this, I think we're looking at some more powerful opportunities. So don't just look at the stochastic at, up near 100 and say, well, I think we're too long, we're going to start looking for shorts. While it may work for you sometimes, I think the most powerful opportunities to use the stochastic is when we see these divergences. A higher high in the actual and a lower high on the stochastic says, okay, now it looks like we're exhausted. The ADX, I've also had my period of time wrestling with the ADX. And the ADX, I think, is a relatively popular indicator when people are writing strategies. The first time I heard about it was with somebody who I knew was codifying a strategy, and he used the ADX not necessarily for a directional tool, but to tell him that the market is, there's enough participation in the market to actually take a trade. I think his number was 24. So the ADX is a tool to determine the strength of a trend, but it's also a tool that can tell you if there's enough participation to believe what you're seeing. You're probably not going to see real high DX in the overnight, but you're going to probably see higher ADX in the regular trading hour sessions. So this black line or gray line right here is the actual ADX, which just is an indicator of participation. Anytime it's up around 25, you're going to see a lot more of your automated strategies kick in, because there's enough participation for them to believe what they are seeing. When we have the red line, the D- line, it's an indicator that the trend to the downside is more prevalent than any trend to the upside. So we see that we've got the red line up here. We see that there's a lower high, higher low here, or a higher high here. It's indicating that there's a stronger probability that the market is going to continue its move to the downside. When there's a crossover, there are strategies that say when there's a crossover like this, you're just supposed to blindly go long. Here, you're supposed to blindly go short, but it's again a lagging indicator. So by the time you get the crossover, you've missed the best trade location. And I've had, like I said, I've had my wrestling with it, because all it does is expand the risk for me. So when I do look at the ADX, it's more of a tool to recognize if the market is offering enough participation for me to get involved. Not saying that I don't get involved if the ADX is below 25, which this is the ADX. This is the D-, this is the D+. This is a market that is increasing in participation and likely to continue to the downside. That's all this tells me. Okay, back to volume and open interest. If you're not looking at volume and open interest, you're missing a big part of the information that the market is providing to you. We have volume, value, and open interest. Volume and open interest. Volume represents the total amount of trading activity or contracts that have changed hands in a given product or commodity in a single trading day. Volume measures the pressure and intensity of price movement. If price is moving on low volume, there's not much behind it. Open interest is the total number of outstanding contracts that are held by market participants at the end of the day. But a lot of folks ask me if you can track open interest intraday, and you cannot. As a matter of fact, I think it's one of the more complicated equations that the exchange deals with, because you can't even get real open interest until well after the open on the following day. Okay, now here's the way open interest works. Okay, it measures the flow of money into or out of a futures contract. When we have open interest, assuming we're trading one contract, one new buyer who's flat and one new seller who's flat trade in the marketplace, they have created a new contract, and that's going to be +1 in open interest. So it's not one new buyer and one new seller add 2 to open interest. It creates one contract. When we have an agreement of this kind, it's one contract. Now that old long, okay, that old buyer and an old short trade, they remove one in open interest. The one long, the old buyer who's holding that position, and the one short, the old seller who's holding that short meet in the marketplace, they remove one in open interest. Now, there's a way that there can be no change in open interest, and this is what this whole thing is about, is risk transfer. A new buyer who's flat buys one from an old buyer who's getting flat. There is no change in the open interest in that regard. Think about when we have short covering, buyers coming in and meeting new sellers. There's no change in open interest in that regard. Okay. Now, I suggest taking a screenshot of this. Okay. The things that this table tells me have for years been able to some degree predict changes in market direction. So if you have price continuing to rise on increasing volume and increasing open interest, price is going higher, volume is increasing, there's more participation, and open interest is rising, we have more contracts being created at higher prices. The market is strong and likely to continue in that direction. But when we have rising price on falling volume and or falling open interest, this market is weakening and a change is likely. Remember, the auction process has a health to it. A market that's with price rising on higher volume and open interest is very healthy, but when price continues to rise over time, but volume and or open interest start to fall off, the health of that upside auction is now in question. That market may be weakening. Okay. Same is true when the market is moving lower. If the price is falling on higher volume and higher open interest, this is a market that is strong to the downside. I know it says market is weak, but it's a strong auction to the downside. It's healthy. It's increasing in volume and increasing in open interest. This is a market that is strong to the downside. And in the same situation with falling price on lower volume and or lower open interest, there is a potential change coming. We are always asking ourselves, what direction is the market attempting to go? Or is it attempting to go anywhere? And if it is attempting to go in a particular direction, be asking yourself, how good of a job is it doing getting there? If it's rising, is volume increasing and open interest increasing? The market's doing a good job. It's likely to continue in that direction over time. But asking yourself, okay, market seems to be rising. How good of a job is it doing? Well, now it's no longer bringing in volume and we're losing open interest. We start losing open interest when we had a healthy upside auction. Open interest was rising. Now it's falling. People are getting out, not coming in to this move to the upside. Now, there's nothing that's going to be finite about this. All it does is give you the nuance or the indication that change may be coming. All right. What is delta? Delta order flow is the difference between the market buys and sells at each price. Footprint delta, in each candle bar delta, or for a period of time, cumulative delta. Forexscalpers.com. Delta is to me, the sum of contracts that trade on the offer minus the sum of contracts that trade on the bid. If you're lifting the offer, it's positive delta. If you're hitting the bid, it's negative delta, plain and simple. Every trade that trades on the offer is positive delta. Every trade that trades on the bid is negative delta. Now, I don't necessarily have the best example for us today. But last Thursday, well, let's take a look at last Friday. This is what delta kind of looks like. Hang on. There's that stochastic. So this is last Friday. This yellow line is the baseline for where the market opened. Initially, the push to the upside brought in positive delta. Okay, the delta kind of went up to about 4,100 positive. Through the rest of the day, more aggressive sellers came in and tried to push this market lower. By the end of the session, we had delta negative of almost 20,000, but the market didn't move lower. When we see this kind of delta, where we have 4,000 positive down to 20,000 negative, that's some pretty aggressive sellers. Those are sellers hitting the bid. But those sellers hitting the bid were unable to push price lower. Okay, that says that there's a snake in the woodpile, if you will. Now, had we seen an increase in open interest on this day, it would indicate quite possibly that because the delta was so negative, but price maintained, at the very least, it maintained, that there were some longer term buyers in this market. Okay, now how are we going to be able to gauge that? Well, in this case, this is a P-shaped profile. This would indicate possible short covering, which should reduce open interest, but it did not. We added 6,184 on Friday here. Negative delta, inability for price to go the direction of the aggressors, which were the short time frame traders using market orders to hit. We had potential evidence of longer term buyers on the end of the, well, through the day on Friday. Because again, we added 6,100 in open interest. So that gives us the idea, okay, well, we got maybe some longer time frame speculators or hedge funds, banks, whatever it is, that are buyers up here. Now, they're not always wrong. They're not always right, but they're not always out there naked either. Our longer time frame traders are holding positions against other positions. So they may not be taking the same kind of heat if it was the short time frame traders up here holding these longs while price was moving against them. All right. So now, when the market is moving higher over time, we saw this a lot last year because the S&Ps were continuing to push higher over time. We would see day after day the short time frame traders hitting bids that were being placed by longer time frame speculators and hedge fund managers, banks, whatever it is. This market eats shorts, and it eats short time frame shorts when the market is pushing higher. We're not in that situation right now, and when we are, we're going to see some really good examples of the short time frame traders trading against the bigger, stronger money, and you're going to see lots of, if you will, capitulation at the end of the day as the market continues to grind short time frame shorts into a small bunch of pulp. So be aware of, number one, of course, open interest, because it gives you an idea of whether money is coming into or out of the market in a particular direction. And watch delta in the day time frame, because you're going to be able to see when delta is severely negative, but price continues to move higher, there's a divergence there. And it's the longer time frame absorbing what the short time frame traders will give them. Yes, it is a divergence for sure. All right, gap analysis. We kind of talked about. Yep.
Hoag, I was thinking it's like right now we might want to just save these last 2 or 3 slides on gap analysis and do them at the beginning of tomorrow, so we can get to a few questions before we sign off today.
Of course, yeah. I'm sorry, I'm just rambling here. I didn't even realize what time it was.
You're never rambling, man. It's all good. I'll go back to turn the camera on, see if it works. Okay, yeah, there I am. All right, so a couple questions and then an open-ended one. First, since the cash close, I'm trying to read this. Since the close of cash or 3:15 or 4 p.m. closes, what do you consider the gap close now, not range? I think it's asking where are you marking the gap?
Okay. Me, I stop my profiles at 3 o'clock most of the time, because that's the cash close. Anything that happens after that is usually going to be short time frame posturing, covering of trades that they're not out of yet, most of the time. So, let's say we have a late spike at the end of the day. We put in a new high for the session, and then the market closes at 3 o'clock. That's where I'm going to leave it. So the gap is going to be above the range of the 2:30 to 3 o'clock bar. So for me, it's always the 3 o'clock close.
Cool. And Matt, there are no dumb questions. The question of where do we see the changes in open interest?
All right. If you're looking at the screen, I'm going to put this link into the chat room for you, everyone. And here's what we look at. So here's equities. If I click on equities, now I'm going to get, this is the final from yesterday. First thing in the morning, I'm going to be getting preliminary. Is it preliminary? It's preliminary. So even the exchange takes a little while to come up with these numbers. So here it is. Here's September settlement, net change, volume for the front month, open interest, and change in open interest. I'm always collecting the total number of volume and the total open interest and net change in open interest. So this morning we were looking at the S&Ps losing 5,200 in open interest on the preliminary. The final came out with an even deeper loss in open interest of 66.66. It's usually not off a lot. It's just going to be off a little bit most of the time until rollover comes in, which further complicates things. I want to take a look here at the crude oil, which is here. You can see why I choose to take all of the volume and open interest, I think, better in the crude oil. This is the August contract here, 104.09 open interest. There's already more open interest in the September contract, even though the volume isn't greater in the September contract yet. But when we look at this, and we're looking at some substantial open interest all the way out to December of 25. If there's hints of changes in open interest and in volume, way far into the future in this market. So that's why I'm always collecting the total volume, total open interest, and total net change of open interest. Okay. But that's where we find it. You bet, Matt. Did we lose you, Jack?
Oh no, I did my damn mute thing. I hate when I do that. Since a
Ah,
pattern is going to either result as expected or fail, is it a good practice to bracket the entry to go with either occurrence? So we'll discuss a lot of the bracket stuff in the trade management session, but is there anything you want to say right off the bat there, Hoag?
um, uh,
Do you tend to trade with brackets, Hoag?
no, well, I do, but they're kind of default, and I change where they need to go once I put the trade on. Sometimes if I'm really, thinking about a trade and it's going to be an all day sucker, I'll put in the stop first, and then I'll put in my entry, um, and just wait and see if it gets filled. I don't see anything wrong with putting in brackets. Um, just each trade has its own risk and its own potential profit target. So I I tend to, I mean, have a default bracket, but each trade again has its own risk and its own profit target possibility. Some trades I won't even put a profit target in if I think it's going to be a trend to one direction or the other, but I'm always putting in a stop. So I'll put in the bracket. I can always cancel the profit target and adjust the stop to where I need, where price is telling me I'm wrong, and I don't move it after that.
I think that's probably the most important thing you said there about it. I think we see far too many people who use the same bracket for everything. Whereas when you're creating your strategy, your target and your stop loss should be dependent on everything else. It's another variable you can play with to see if your strategy works. And I don't think it's one size fits all there.
Yeah,
So
100%. If you're always using a static stop, it's usually not going to be in the right spot.
yeah. All right. One last philosophical question, and then we'll be back tomorrow, guys. I'm going to try. I have everything set up now, so I'm going to have this recording posted this afternoon, I think. It takes me a couple hours to load it on YouTube. What was your patience like when you first started trading? If it wasn't great when you started initially, what helped you improve?
Well, when I first started, I was in the pit, and I was put in there to basically scalp. So patience was not a virtue. It drove me crazy. I did not necessarily feel as though that was the trader I was meant to be, and it showed for the first year or two. It wasn't until the friend of mine handed me Mind Over Markets and told me to read the first 100 pages of it, to where I really started to understand where patience can be a virtue in trading. But again, I'm like everything. I'm like everybody. I want it now. And it's something that you have to build the muscles to understand that, sometimes the best thing to do is sit on your hands, even if you have a position on, to maximize your profit. Patience. I'm like everybody else. I was an artist, and I was a tactical artist. So everything that I touched made a change, and there was a certain amount of of um, um, instant gratification in that. And I, tried to bring instant gratification into trading, which was possible as a very short time frame scalper. But as it turned out, it didn't really fit me as a person, I guess. And I had to learn to strengthen those muscles, slow things down, look for better opportunities and better trade locations. And the market profile is what really brought that home for me.
Great. Okay, we'll talk about that a little bit more in the last session when we go into psychology and stuff. But In the meantime, thanks everybody for coming along today. Tomorrow we'll be doing market profile, which is a big thing for Hoag. And with that, I'll let you sign us off, Hoag.
All right. Thank you, Jack. Thank you, JD. Thank you all for attending today. And again, if there's something that you're able to move forward and carry with you in your trading career that's going to help you, it's all been worth it. That's our goal. Love to see your success, and I look forward to it. So we'll see you on the recap today at 3:00, and back again tomorrow morning for the forecast, and back for day 3 of market profile information in trading strategies. So we'll see you then. Have a great day, everyone. Trade well.